Hi everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to make my presentation on the topic Internal Rate of Return Method, which is shortly known as IRR. This is one of the discounted cash flow methods of capital budgeting. You find a couple of details of mine. After you watch the full video, if you find the video beneficial to you, give a like to the video and do subscribe my channel so that you will get the notifications of my future videos. Internal rate of return method. Internal rate of return is defined as the interest rate that equates the present value of the expected future receipts to the cost of the investment outlay. In simple terms, I could say IRR is the rate which equates the present value of future cash inflows of a project with the present value of cash outflow, which is nothing but investment of the project. For example, if you are investing 50,000 rupees on a project, that is the present value of cash outflow. Now, you expect the cash inflows from the project for another 5 years. It is like 10,000, 15,000, like that. The total comes to say 1 lakh rupees in the 5 years. When you calculate the present values of the future cash inflows of the project for 5 years, at which discount rate the future cash inflows of the project for 5 years is exactly equal to 50,000 rupees, and that rate is nothing but IRR. So, very simple. The discount rate which equates the present value of cash outflow of the project with the present value of cash inflows of the project is IRR. That's what about the idea behind IRR. We can only make a trial and error method to calculate IRR. We can try 10% or 15% like that. But still I will teach you a method which is nothing but factor to be located, which will enable you to make just 2 or 3 attempts and find out the exact IRR for a problem. I will teach you that at the end of the video. Let's go by what is presented here. If the present value calculated as per a particular trial is higher than the cost figure, we try a higher rate of interest next and go through the procedure again. Suppose when you calculate present values of future cash inflows of a project at 10%, the total present values of the future cash inflows at 10% is higher than the investment done on the project, which is nothing but present value of cash outflows of the project. What we do? We try a higher percentage, so that we will get lesser total present value of future cash inflows of the project. So conversely, if the present value is lower than the cost, lower the interest rate, fine. As this determination of internal rate of return involves a number of attempts to make the present value of earnings equal to the investment, which is nothing but present value of cash outflow, this approach is also called as trial and error method. Now let's look at the problem presented here. Initial investment of the project. Initial investment 60,000 rupees. Life of the asset 4 years. Estimated net cash inflows, which is nothing but profit after tax but before depreciation. That is what known as cash inflows. First year 15,000, second year 20,000, third year 30,000, fourth year 20,000. Calculate IRR. Now, in this solution, they have first tried at 10% PVIF. At 10% PVIF, they have written down the PV factors for first year, second year, third year and fourth year, which could be found in PVIF table as presented here. See 10%. This is a present value of rupee 1 PVIF table. At 10% for period 1, 0.909, for 2, 0.826, for 3, 0.751, for fourth year, 0.683. This is what picked up and presented here. Fine. The cash inflows of every year is multiplied with the respective PVIF factor at 10%. They have come to know the present value of cash inflows. If you total the present value of cash inflows of the project for 4 years, you get the total of 66,345. The 66,345 is higher than our project investment. Let us try another higher percentage. They have tried 12%. Similarly, present value factors at 12% are picked up from the table at 12%, 0.893, 0.797, 0.712 and 0.636. And that is what presented here. Cash inflows are multiplied with the present value factors at 12%. They have come to know the total of 63,350. Still, this value is higher than the value of our project. So, let us try 14%. Similarly, they have written the present value factors at 14%, which have been found in the table. So they have now multiplied the annual cash inflows of the project with the respective present value factors of the years at 14%. They have come to know the total as 60,595. Still, you find the present value of cash inflows are higher than the present value of cash outflow, which is 60,000. So let us try another higher percentage. 15% they have tried. Since they have tried 10%, 12%, 14% and 15%, this method is really called as trial and error method. That's a simple idea. So they have now calculated the present value of cash inflows at 15%. It comes to 59,285. This is lesser than our investment on the project or present value of cash outflows. Now, making use of the statistical technique named interpolation, we have to find out what is the exact percentage at which present value of cash inflows will be equal to present value of cash outflows. Initial investment is 60,000. Hence, the internal rate of return must be between 14% and 15%. The difference comes to 1,310. What is that? Difference between the total present values at 14% and total present values of cash inflows at 15%. Between these two figures, what is the difference? 1,310. What is the difference between the two rates, 14% and 15%? It is 1%. For 1% difference, you find the difference in the present values of cash inflows is 1,310. So for 1%, you find the amount stands as 1,310. At 14%, what is the total present value of cash inflows? 60,595. Now the target figure is what? 60,000. What is the difference between the two? 595. So we want to find out which percentage gives the present value of cash inflows amounted 595. Therefore, exact internal rate of return is equal to 14%. As I said, it lies in between 14 and 15, right? 14% plus 595 divided by 1,310 into 1. For 1,310, the percentage is 1%. For 595, what is the percentage? It's a proportionate calculation. It comes to 0.45%. Therefore, at 0.45%, present values of all these cash inflows will be equal to 595. That is the idea. So, the total IRR is nothing but 14.45%. The method what we have used here is interpolation. Fine. I teach you another way. What you do, instead of trying 10%, 12%, arbitrarily, first sum up all these annual cash inflows of the project. If you sum up them, it comes to 85,000. 85,000 divided by how many years? 4 years. So it comes to the average cash inflow of 21,250. Now, what is the investment made on the project? It is 60,000. 60,000 divided by 21,250. You get the value of 2.8235. Now you go to PVIFA table. That's the second table. That means present value interest factor annuity. The meaning is what? If you continue to receive the same amount for a stipulated period with equal interval, it is called annuity. So, in that situation, you have to refer this table. But here, for easy understanding, what I recommend to you, go to the 4th year. Find the value which is either the same value what we have calculated, the 2.8235, or the value which is closer to this value. Now 2.8235. 2.8235. See here, fine. Here 2.914, 2.855, here 2.798. For a safer side, I recommend to you, you try only two percentages, which is nothing but 14% and 16%. You try first 14%. The total present value of cash inflows will be higher than 60,000. Then you try 16%. Don't even try 15%. Try 16%. You will get the total present value of cash inflows less than 60,000. So one total present value at a percentage should be higher than the target value 60,000. The other one should be lesser than the target value of 60,000. This is an idea. So 14 and 16% if you try, you can easily get the same answer. So here what you can do, 14% plus. Here the same amount will come. At 14%, you get the present value of cash inflows amount at 60,595. The target figure is 60,000. Therefore, it is going to be the same 595 in my calculation also. Divided by 2,620, because the difference between the two percentages will be 2% in my suggestion, because I want you to try 14 and 16%. The difference between the two is what? 2%. So therefore, here into 2% and the denominator over here will be 2,620. So if you calculate, you will get the same 0.45 and the final answer will be 14.45%. Using my idea, you can simplify the trial and error method. Instead of trying these four percentages, right? Instead of calculating present value of cash inflows at four different rates, you can do it just with the two rates. I hope I have given my lecture up to the level of your satisfaction. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.